Is chasing higher property yield in 2026 quietly putting your freedom at risk? And what if the biggest danger next year isn't the prices falling or markets crashing, but being stuck in a property you can't move out of when life changes? Okay, so have you noticed the numbers still look fine, but something inside you feels uneasy? Well, have you felt that strange tension where everything makes sense on paper, yet committing feels heavier than it used to be? Well, because I'm not going to tell you where to buy and what will go up. I'm going to show you how Singapore and Malaysia actually behave in 2026 solely based on Timan annual chart. Okay, because most people don't lose money from bad properties. They lose because misunderstanding the timing. And of course, 2026 is a timing year. And because if you are deciding between Singapore and Malaysia, what you're about to hear could save you years of quiet frustration. And what will you actually walk away from watching this video? Well, you understand why yield matters less than liquidity in 2026. You will see why Singapore and Malaysia are not competing markets at all. And you also recognize the hidden risks that never appear on spreadsheets but always show up later in real life. And if conversations like this help you think more clearly, subscribe to my channel if you haven't done so. Turn on the notification bell and share this with someone who was wrestling with the same decision. Okay, now let me slow down and talk to your property. Now, if you're watching this, you're probably not looking for hype. You're looking for clarity or reassurance that you are not imagining things. You might already own properties. You might be planning your next move. You might be comparing Singapore and Malaysia late at night. We're running the numbers again and again. And despite everything looks fine, something feels off, isn't it? Well, I'll say that you're not wrong. But just a quick disclaimer before we go further. While I'm not giving any investment advice, I'm not telling you what to buy, what to sell, or avoid anything, okay? I'm not a registered property agent in both countries. But what I'm sharing is purely from a timing and behavior perspective using the Timan annual chart for 2026. Once again, Timan is not about predictions. There's no promise I can give to you, and I'm just providing one thing called clarity. Now, once again, Timan is not about predicting prices or outcomes, and most people actually got it wrong. Think of it as a behavioral weather map. It shows where the movement is smooth, where things slow down, where people tend to freeze, rush, or overcommit. And generally, for those who have not come across with a Timan chart, we look at the four things. The doors, which means how easily things move. The stars, what kind of force dominates. Deities, who benefits and who struggles. And the stands, how capital behaves under pressure. And I will be using concepts like open door or rest door. Now, first of all, I'm not talking about any symbols. All I'm doing is to describe how easy or difficult it is for money to move in 2026. And of course, Timan doesn't replace financial analysis and due diligence. You still have to do this, isn't it? Timan only explains the human behavior layer, which numbers alone cannot show. Okay, so now let's set the context of this Timan annual chart analysis. So for this analysis, I've mapped the following. I use the Southeast Palace for Singapore and South Palace for Malaysia. Yes, I can explain the technicalities behind, but I'm not going to because many people like you may not be interested in the actual Timan analysis. All I'm saying is that I'm using the same chart, same year, equal footing. That is it. So now let's walk through what the chart actually says, shall we? Okay, so let's look at the Malaysian 2026, which is based on the South Palace Timan structure. Now you see, Malaysia is in the South Palace in 2026 annual chart. And what do we have there? This palace contains the level 7 night earth, heavenly ambassador, rest door, the gunmetal, and the tea earth. Now, I know you're not human practitioner. You may not understand what I'm talking about. So let me translate this into human language, shall I? So the ninth earth is about accumulation and storage. So money goes in easily and it tends to settle, however. So at a higher level, this tells me that Malaysia is a capital absorption market in 2000. And then we have the heavenly ambassador, which means that the market is welcoming outsiders. So that could mean foreign buyers, cross-border capital, entry feels smooth and friendly. Now, here comes the critical piece in this palace, the rest door. So the rest door doesn't mean safety, okay? Don't get it wrong. It means pause, delay, inertia. So what does it mean? It could mean that liquidity doesn't disappear, but it stretches. And we have gunmetal and G-earth, which show defensive capital behavior. So you see people buy to pack the money, but not rotate quickly. So Malaysia in 2026 isn't testing whether you bought the right property. It's testing whether you can wait without becoming anxious. Now, the question is, how do people get into trouble in Malaysia in 2026? Well, I come up with 3 mistakes. Mistake number 1, believing yield will protect you emotionally. Yeah, monthly income feels reassuring, but it doesn't tell you how quickly capital can come back to you when life changes. Make sense? Number 2, the second thing is assuming eventually is a strategy. Eventually is a strategy. Most people don't plan badly, they plan optimistically. So in 2026, delays don't come from crisis, they come from inertia. So the third mistake is emotional overcommitment. So easy entry creates attachment. True. When exits slow, frustration replaces objectivity, and forced decision appear. So to sum up, Malaysia in 2026 actually doesn't really punish bad assets, but what it does is to punish impatience. Make sense? Okay, so now let's move on to Singapore. We use the Southeast Palace Timan structure, and then this palace actually contains the following. We've got the level 5 9 heaven, heavenly grass, open door, earth and thing fire, and also the neck constellation. So again, purely based on the plain language that you and I can understand, 9 heaven represents macro control and oversight. So that could be policy, structure, strategic pacing. And then heavenly grass points to slow, sustainable accumulation, which means there won't be dramatic windfalls compounding over time. We have open door, which tells us something important. Liquidity exists, transactions still happen, but the neck constellation creates the bottleneck. Not everyone passes through. So that means there's no blockage, it's purely filtering. With earth and thing fire, which show that substance matters. So real use cases win. Speculative demand get exposed. You understand where I'm coming from? So Singapore 2026 is this. It doesn't really block capital, but it filters it. So the question is, how do people misread Singapore in 2026? Again, I come with 3 mistakes. Mistake number 1 is to assume calm means easy exit. Well, like I said earlier, liquidity does exist, but not on demand. Second mistake is stretching leverage because stability feels safe. So you see in a filtered market, leverage removes option when flexibility matters. And lastly, confusing patience with neglect. It means holding without reviewing buffer or exit readiness is not patience, it's actually avoidance. So for Singapore, it rewards active patience, not passive hope. So now overall, I'm going to give you 5 themes for 2026 when it comes to investing in properties in these countries. Well, theme number 1 is liquidity matters more than yield. So in 2026, yield stops being comforting when flexibility matters. Cash flow looks good until movement becomes important. So 2026 quietly rewards people who think about how money moves, not just how you. And the theme number 2 is this. Singapore and Malaysia are not competing markets. Most people actually got it wrong. They actually solve different problems. Singapore protects capital through control, whereas Malaysia attracts capital through accessibility. Now, no one is better here, no one is worse here. Choosing the wrong one, unfortunately for your temperament, will create the tension. Theme number 3 is stability no longer means speed. Calm markets can still move slowly, and liquidity friction doesn't announce itself. You only feel it when you want to add and realize the market is not responding. This is what we feel in Singapore right now. Theme number 4, exit clarity matters more than entry confidence. And most people actually focus on buying well, while very few think deeply about exiting calmly. In 2026, a clear exit saves average entries, while a vague exit destroys good ones. Make sense? And theme number 5, 2026 rewards temperament, not excitement. Now, 2026 definitely is not a year for emotional decisions. It quietly tests your self-awareness. Markets don't break in 2026. Who break? You and me, people. Okay, so what are the risks that you should be aware of in 2026? Well, I'll share with you a couple of things here. So liquidity illusion. And that in fact the most dangerous risk is assuming liquidity will always be there when you need it. Everything looks fine until many people want to move at once. Singapore, remember, filters liquidity quietly, whereas Malaysia stretches it. Number 2, yield as emotional comfort. Now, you can calm nerves while hiding deeper issues. Monthly income feels like progress, but it doesn't guarantee freedom. So in 2026, many people learned that earning money and regaining flexibility are very different experiences. Number 3, time to exit drift. So most investors plan clean exits. Few plan for delays. In 2026, exits aren't delayed by drama. They are delayed by waiting. And that slow drift quietly drains confidence. Beware of that. Number 4, emotional forcing. You see the market, don't panic first. People do. So when expectations break, even good assets feel unbearable. Forced decisions usually come from emotional pressure, not bad investments. And finally, Siemens thing, timing mismatch. A good market at the wrong moment can feel like a mistake. And most struggles come from expectations that don't match the year you are actually in. So I hope that these mistakes make sense to you. If you have any questions, let me know, comment below. And remember this, my final word is nothing in this video is about giving you any form of recommendation. All I'm doing is to talk about Siemens as a lens to look at the timing and behavior in 2026. You see, once again, 2026 doesn't punish property buyers, but it do challenge people to understand liquidity, patience, and themselves. So finally, to conclude, you may ask which country? Well, how about this? Singapore works. Malaysia also works. But just not for the same kind of people. Okay? So if this helped you slow down and see more clearly, let me know, comment below. I will continue this conversation quietly in future videos. And for deeper conversation, I'm going to put it under our private Telegram checkout, the Destiny Architect. Again, I'm here to give you more insights using Siemens analysis. I hope you enjoy it. And if you have any other questions about which countries property market you want me to look at, or specifically Siemens' question about investing in property market in 2026, comment below as well. Let me evaluate your considerations and I may do further videos on that. Okay, so thanks very much everybody. Take care. Before we end, before you stop watching the video, subscribe to the channel if you haven't done so. Click the notification bell, and most importantly, share with your friends, your loved ones who are also investing properties in this region. Okay, thanks for watching. I'll see you in my next